Okay, economists, we are here thinking about our next topic on the guide, and that is monetary policy. Specifically, the topic of this video is we're going to think about how interest rates, which are a really important indicator and a very important function that determines what goes on with a nation's national economy, we're here to think about how interest rates are determined. And the short answer to that is interest rates are determined by the central bank. But I will say there's a lot of misunderstandings about how interest rates are set that we'll try to address in this video. So interest rates are only partly set by a nation's central bank. They really only control half of the equation when it comes to how interest rates are set. So the diagram I'm going to talk you through behind me here is called the money market diagram, right? So this is showing the market for money. And as you might notice, the market for money functions, well, just like any other market. It has supply and it has demand. And what's important to note is that the central bank only controls the supply for money. Okay, they only control the supply for money. You might notice that our supply curve on this diagram is perfectly inelastic, and then it's straight up and down, and that there really is no relationship between whatever the interest rate is and the amount of money that is out there. Okay, the reason for that is that our money really only comes from one place, and that's the central bank. So since there are no real substitutes for this, there's only one source of this money. It comes from the central bank. That's why we draw our supply curve like that. Okay, so a central bank can either increase the supply of money or they can decrease the supply of money. We'll talk about that in a second, but the other thing to note here obviously is the demand for money. The central bank has no control over this whatsoever. The demand for money is really made up of individuals or groups of individuals who are interested in borrowing money. That's who demands money. Demand for money can increase and decrease, and that mostly happens based off of expectations. If business confidence and consumer confidence are both high or increasing, we'll see that the demand for money will also increase. Now, the opposite's also true. If we're in a really deep recession and there's very low confidence, or let's say a pandemic, right, the demand for money is going to decrease because people really aren't interested in loaning out more money. They're worrying about keeping the money that they do have, right? So the central bank only controls the supply for money. So for that reason, we're going to assume that the demand for money is going to stay right where it is, and we're going to show an increase in the supply of money for expansionary monetary policy, and a decrease in supply for contractionary monetary policy. Now, another misunderstanding about interest rates is that a central bank just kind of sets them magically and says, okay, that's the interest rate. That's not exactly how it works. A good way to think about an interest rate is that it is basically the price for money. If you possess money and you want to loan it out, you're going to charge an interest rate, and that charge goes to the person borrowing the money from you. If you are the borrower and you are making up the demand for money, you have to pay a price to borrow that money, and that's the interest rate. So, like all prices for things, it's set by supply and demand, and it's really set by the equilibrium of the supply of money and the demand for money. So central banks can't just pick a magic number and then wave their magic interest rate wand and make the interest rate be whatever they want. They have to adjust the supply of money relative to the demand for money to get the interest rate that they want. Okay, and also central banks cannot magically make the supply of money increase or decrease. They have some tools at their disposal to do that, which we'll talk through in a second. But maybe we should back up a bit and think about what a central bank is as an institution. Okay, because there's a lot of misunderstanding also about what a central bank is. Okay, so a nation's central bank, in the United States here we have the Federal Reserve. Okay, the Federal Reserve is basically a separate financial institution from government. Okay, so these people, they're not representing the government. They don't work for the government. They are their own sort of separate financial entity. They make decisions in a completely different way than, or maybe completely independent from what the government's doing. The really only connection there is that the Board of Governors, the people who sit on the Federal Reserve that make decisions about monetary policy, they are appointed. They are appointed by the government. They have to be confirmed by Congress. But they are meant to function very much independent of the political processes of government. So a good way to think about a central bank is they're kind of like the Supreme Court of the economy. They function, and the decisions that they make are separate from the political pressures of government. Okay, so they're a separate financial institution from the government, and what they really do is they set rules for commercial banks. So it's important to make the distinction between a nation's central bank, like the Federal Reserve, and commercial banks like a Bank of America or a JP Morgan Chase, right? Those are commercial banks that people loan money from and deposit their savings into. The central bank sets the rules for those commercial banks. Another good way to think about a central bank is that they are a bank for banks, okay? So these commercial banks that do most of the borrowing and the lending, one of the things that they do, one of the sources that they get their money from is the central bank. So commercial banks will borrow from central banks when they need to, and that's part of the regular banking process. And when the commercial banks borrow from the central bank, of course, they get charged an interest rate. We'll talk about that in a second, though. So those are the kind of the two core functions of what a central bank is meant to do. It's a separate financial institution that sets rules about how to do banking by commercial banks, and then they are also a bank for banks and a lender of last resort. Now, about the past 20 or 30 years, there's been a bit of an experiment going on where the nation's central bank sort of controls the money supply, and they do so in pursuit of some macroeconomic objectives. So this probably is where the line between the central bank and the government gets a little bit blurry, because a lot of economists are in debate about whether or not central banks should be doing this, controlling the money supply back and forth. But that is one of the things that they do. So let's talk about how a nation's central bank will adjust the money supply. A helpful analogy to distinguish expansionary monetary policy from contractionary is to think about stepping on the gas pedal or the brake of a car. If you step on the gas pedal of a car, that will make the car go faster because it puts fuel into the engine of the car will go faster. That's basically expansionary monetary policy. When we have expansionary monetary policy, the central bank is trying to increase the amount of money in circulation. Remember our circular flow diagram, right? Trying to increase the amount of money in the circular flow, and that will lead to an increase in economic activity and ultimately GDP. That's stepping on the gas pedal of the car. Now let's say our engine is overheated and we need to slow this car down. Then we'll use contractionary monetary policy, where the central bank will take money out of circulation and raise interest rates and hopefully slow this car down. Okay? So how do they control the money supply? Well, they have three tools to do that. The first one is the reserve requirement. The reserve requirement is basically the percentage of a bank's savings deposits that they have to keep on hand and not loan out. Okay? So that's a good way to think about that, is money not loaned out by the bank. That's how banks make money, is they give out loans and they charge an interest rate for those loans, right? So if the central bank was looking to increase the money supply, they would lower the reserve requirement that commercial banks have to follow, because then that would mean the commercial banks have more money to loan out. Okay? The other tool they have at their disposal is the discount rate. The discount rate is the rate at which the central bank charges interest for commercial banks when commercial banks want to borrow money from the central bank. So if they were looking to increase the amount of money in the money supply, they would lower the discount rate, because that would make it cheaper for commercial banks to borrow from the central bank, and then those commercial banks would take that money and they would loan it out to whoever is interested in borrowing and making up our demand for money. Okay? So, expansionary monetary policy would mean that we would lower the reserve requirement, we would lower the discount rate, and this gets a little bit confusing here with open market operations. A good way to think about that is buying and selling government bonds. So if the central bank was looking to increase the money supply, they would buy government bonds. Okay, so government bonds are a type of investment, and what the central bank will do here is they will approach people who are in possession of those bonds and offer them cash in exchange for that investment. So when the central bank is doing that, they are buying bonds, they are taking the cash that they have, and they're approaching investors and saying, I'll give you cash for your bond. When they do that, that investor now has more cash in their hands, and then they will go spend it and put that money in circulation. Okay? So if the central bank lowers the reserve requirement, lowers the discount rate, and buys bonds, we'll see an increase in the money supply. We can draw that pretty simply. Okay, supply of money 2. And obviously the interest rates, the price for money would come down, and the quantity of money in circulation would increase. Okay, so again, they haven't just magically adjusted the interest rate, they have increased the supply of money relative to the demand for money. Interest rates are cheaper now because interest rates are lower because there is now more money in circulation. And it's important to pause for a second and think about what might be the consequences if interest rates decline. We're going to have a follow-up to this video just at the end here. Okay? So that is expansionary monetary policy. That is the central bank stepping on the gas pedal of the car. So let's talk about, obviously, contractionary fiscal policy. What you can hopefully do by now is imagine a set of circumstances whereby a nation's central bank would actually want to increase the interest rate. That should be pretty clear. So how would they go about increasing the interest rate? Well, they'd have to reduce the money supply and take money out of circulation. How would they do that? Well, one thing they could do is force banks to keep a greater percentage of savings deposits in their vaults and not loan them out. That would decrease the money supply. I just realized I didn't draw this correctly. So the reserve requirement, would go up. Okay. The discount rate would also go up. As in, the central bank would charge more money to commercial banks for borrowing money from the central bank. Okay, so commercial banks would then, of course, borrow less, which means they would have less to loan out to people who make up the demand for money. And finally, open market operations. What would the central bank do? They would sell. Okay, they would sell the government bonds that they are in possession of. Now, you might be thinking, well, how would that take money out of circulation? Let's say, as an individual investor, I am interested in buying some government bonds. If the central bank went and sold them, I would take, let's say, $100, and I would give it to the central bank, and then they would take that bond. That would take money out of circulation because that would be $100 that I could have gone and spent and kept in our circular flow model, but instead that would go to the central bank and leave the circular flow, basically. So these are labeled correctly, by the way. Sorry, I got confused there for a second. So All these things will reduce the money supply. Raise the reserve requirement, raise the discount rate, sell bonds, right? That would take money out of circulation. Again, we would decrease the money supply. And in doing so, money would become more scarce. Anytime something gets more scarce, the price for it will go up. In this case, our price for money is the interest rate. Okay, so those are our tools of monetary policy. Let's fully label this one before we go. Supply of money 2 with a nice arrow. Okay, so these are the tools, right? The central bank can only control the supply of money. They really have no control over the demand for money. And these are the tools that they would use to do that. So what I want you to think about now before we finish up with this video is what would be the consequences of lowering interest rates on an aggregate demand and aggregate supply diagram, and then what would be the consequences of increasing interest rates on an aggregate demand and aggregate supply diagram. That answer should be pretty clear. A really good strategy to use, whether depending on the question for a paper 1 or whatever might be going on in an internal assessment, is to use this money market diagram alongside of an ADAS diagram, as in showing that in sort of a cause and effect type of situation, and that whatever's happening in the market for money has a pretty significant impact in what's going on with aggregate demand and aggregate supply. Okay, so a lot going on in this video. Central banking is pretty complicated. There are a lot of misunderstandings about it, but hopefully this video gave you some idea of the basics here. Okay, thanks guys.